Something extremely important just unfolded in the silver market. And if you are watching precious metals right now, the next few weeks may end up being one of the most decisive periods we have seen in years. Silver has suddenly dropped below the $82 level and is currently trading around $81.86 in the spot market, while COMEX futures are hovering near $82.02. On the surface, this looks like a sharp decline, nearly 2% in a single day, and many investors immediately interpret red numbers like this as a warning sign. But the deeper story behind this move is far more complicated, and it is directly connected to a major announcement coming out of China that is now shaking commodity markets across the globe. The key question investors must ask themselves right now is whether the sudden pullback in silver represents a rare buying opportunity after a historic rally, or whether it signals the beginning of a more painful correction that could extend further before the next major move begins. To understand the significance of what is happening today, we need to step back and look at where silver has just come from. Many people are staring at the drop from above $100 and focusing only on the decline, but that ignores the extraordinary rally that preceded it. Silver reaching $100 per ounce was not simply speculation or hype. That milestone actually happened. For years, Keith Neumeyer, the chief executive officer of First Majestic Silver, repeatedly argued that silver would eventually break into triple-digit territory. At the time, those predictions were widely dismissed. Critics said it was unrealistic. Many people laughed at the idea and believed silver would never approach those levels. But reality proved otherwise. Silver did not merely touch $100 briefly and retreat. It surged past it with remarkable momentum and continued climbing even further. Today, the historical record shows that silver reached an all-time high of $121.62 per ounce. That number is not theoretical, and it is not an estimate. It is the actual peak price silver achieved during the rally. From that extraordinary high, the metal has now retreated to the low 80s. That represents a decline of more than 30% from the peak. Whenever a market falls that far after a strong rally, it inevitably raises serious questions among investors. Is the long-term bull market over? Is this simply a normal correction after an explosive move upward? Or was the rally itself built on unstable foundations that are now collapsing as reality begins to catch up with expectations? Before jumping to conclusions, we need to understand why silver rallied so dramatically in the first place. Markets rarely move hundreds of percent because of a single headline. Large price movements typically occur when multiple powerful forces converge at the same time. In the case of silver, three major drivers combined over several years to create the conditions for that massive rally. The first driver was prolonged economic uncertainty across the global financial system. Inflation remained stubbornly persistent even after central banks insisted it would fade. Interest rate policies shifted repeatedly between tightening and easing. Government debt levels continued to expand while many national currencies experienced volatility. Throughout this period, confidence in traditional fiat monetary systems never fully recovered from the aggressive money printing policies implemented earlier. When investors begin to question the stability of currencies and financial systems, they often turn toward hard assets. Gold historically moves first in that environment, and silver typically follows. Because silver is a smaller and more volatile market, once momentum builds, it often accelerates much faster than gold. The second major driver behind the rally was geopolitical instability. The past 2 years have produced a level of international tension that rivals some of the most unpredictable periods in recent history. Political developments surrounding Greenland created shockwaves across Europe and raised new questions about strategic resources in the Arctic region. Those developments were not simply political headlines. They introduced real uncertainty about alliances, territorial influence, and resource competition. At the same time, discussions about possible military action involving Iran injected additional tension into global markets. The Middle East was already dealing with fragile stability, and the possibility of direct escalation increased the demand for safe haven assets. Whenever investors begin to worry about conflict or geopolitical disruption, precious metals tend to attract increased attention. Silver benefits from the same dynamic that supports gold during uncertain times. Fear drives capital toward tangible assets that exist outside traditional financial systems. The third and often most underestimated factor behind silver's rally is the structural supply deficit that has been developing quietly for years. Unlike many other commodities, silver demand has been expanding across multiple industries simultaneously. Modern technology relies heavily on silver's unique physical properties. It is the most electrically conductive metal known, which makes it essential for electronics, solar panels, and various advanced manufacturing processes. The rapid growth of renewable energy systems has dramatically increased demand for silver in photovoltaic solar installations. Electric vehicles also require silver for electrical components and circuitry. In addition to those industries, silver continues to be used in medical technology, batteries, semiconductors, and countless electronic devices that power the digital economy. At the same time, demand has been expanding. The supply side has struggled to keep pace. Silver production does not respond quickly to rising prices because most silver is not mined as a primary metal. Instead, it is usually produced as a byproduct of mining operations focused on copper, zinc, or lead. That means increasing silver supply requires expansion in base metal mining operations, which can take many years of planning, permitting, and investment before production actually increases. On top of that, ore grades at many mines have been declining, making each ounce more expensive to extract. Mining companies are also dealing with higher energy costs, labor expenses, and regulatory pressures. These factors have constrained supply growth at the exact moment global demand has been accelerating. As investment demand began to rise alongside industrial demand, the pressure on supply intensified. Refineries experienced bottlenecks. Mints struggled to produce enough coins and bars. Physical premiums above spot prices began to rise sharply as buyers competed for available metal. Over time, a noticeable gap started to appear between the paper price of silver traded in futures markets and the price buyers were paying for physical metal in the real world. When institutional capital finally began flowing into silver markets in large quantities, the limited supply could not keep up with demand. That imbalance created the conditions for the explosive price movement that pushed silver beyond $100 and ultimately to its historic peak above $121. Now, after that powerful rally, silver is trading near $82 following today's decline. At first glance, the drop appears dramatic, but markets rarely move in straight lines. Corrections are a natural part of any long-term trend. The real question is whether the underlying drivers that pushed silver upward have actually disappeared or whether they remain intact beneath the surface. The catalyst behind today's decline came from China, where officials announced a new economic growth target for the coming year. The updated target range is between 4.5% and 5%. That number is slightly lower than the previous year's 5% growth rate. When investors hear that the world's second largest economy expects slower expansion, commodity markets often react immediately. China plays an enormous role in global industrial demand, and any signal of slower growth can influence commodity prices. The announcement also affected currency markets. The Australian dollar weakened against the United States dollar after the news because Australia's economy is closely tied to Chinese trade. Commodities including silver reacted quickly to the shift in expectations. But interpreting this development requires careful analysis. A modest reduction in China's growth target does not automatically translate into collapsing demand for industrial metals. The economy is still expanding, and even slower growth in a massive economy can still generate substantial demand for raw materials. Understanding whether silver's current decline represents danger or opportunity requires looking beyond the immediate reaction in markets. Investors must examine whether the fundamental forces that pushed silver to historic highs remain active. Economic uncertainty has not disappeared. Geopolitical tensions remain unresolved. The supply deficit in silver has not suddenly been solved. Those structural forces do not vanish simply because prices correct after a rally. What we are witnessing now may simply be the market adjusting after a rapid move upward while digesting new economic signals from China. That is why the coming weeks will be critical for determining silver's next direction. Markets often test investor confidence after major rallies, and corrections can shake out weaker hands before the next phase of a trend begins. The challenge for investors is separating short-term volatility from long-term fundamentals. A 30% pullback may appear alarming, but it must be viewed in the context of a massive rally that carried silver from far lower levels to historic highs. Whether this decline ultimately becomes a generational buying opportunity or the beginning of a deeper correction will depend on how the underlying economic and geopolitical forces evolve from here. To evaluate whether this decline in silver is temporary or something more serious, it is important to examine both sides of the argument carefully. Many investors immediately assume that falling prices mean the bullish story is finished, but markets rarely operate in such a simple way. When an asset rallies nearly 200% in a relatively short period of time, corrections are not just possible, they are almost guaranteed. A market that moves straight upward without pauses usually becomes unstable. Profit-taking begins, leveraged traders get forced out of positions, and the price retraces part of the move before the next trend develops. That process can be uncomfortable, but it is a natural part of how markets function. The bearish argument surrounding silver right now focuses primarily on the signal coming from China. The updated growth target between 4.5% and 5% suggests that policymakers in Beijing expect a more challenging economic environment ahead. When the world's second-largest economy anticipates slower expansion, investors often assume that industrial demand for commodities could weaken. Silver is not only a precious metal used for investment purposes. Nearly half of global silver demand is tied to industrial activity. Manufacturing, electronics, renewable energy systems, and technological production all require significant quantities of silver. If Chinese factories slow down, or if construction and export demand weaken, the consumption of industrial metals could decline. China's economic influence extends well beyond its own borders. A slowdown in Chinese manufacturing can ripple through global supply chains and reduce demand for materials produced by other countries. Australia felt this reaction immediately after the announcement, as the Australian dollar weakened against the United States dollar. Australia exports large quantities of raw materials to China, so any hint of slowing Chinese growth can affect expectations for Australian trade. Commodity markets often move together in response to these signals, which explains why silver and other metals experience pressure following the news. Another factor contributing to the bearish case is the scale of the rally that silver experienced before this decline. The metal rose from around $30 per ounce to over $120 in roughly a year. That represents an increase of approximately 189% in 12 months. Moves of that magnitude almost always attract speculative participation. Traders who enter late in the rally often use leverage to amplify their positions. When prices begin to fall, those leverage positions can unwind quickly, accelerating the decline. Margin calls force traders to sell, which adds additional downward pressure on the price. Psychology also plays a major role during corrections. Investors who purchase silver at $100 or above are now holding positions that are underwater. When prices fall 30% from the peak, some participants begin to panic. Fear replaces the earlier excitement that surrounded the rally. People who expected prices to continue climbing indefinitely suddenly question whether the entire bullish narrative was flawed. This emotional shift can cause selling to accelerate, at least temporarily. The bearish perspective argues that this correction may not be finished yet. According to this view, silver could decline further before stabilizing, possibly retesting levels around $70 or even $60 if market sentiment continues deteriorating. However, while the bearish argument appears logical at first glance, it overlooks several critical factors that continue supporting silver's long-term outlook. The first point to understand is that China slowing slightly from 5% growth to a range of 4.5% to 5% does not represent an economic collapse. China's economy remains enormous and continues to expand. Even slower growth in such a large economy still represents significant demand for industrial materials. The adjustment in expectations may reflect caution from policymakers rather than a dramatic decline in real economic activity. Another important factor involves central bank behavior, particularly among countries outside the Western financial system. In recent years, central banks in nations such as China and Russia have been aggressively accumulating gold as part of their reserve strategies. This trend reflects a broader shift toward holding tangible assets, rather than relying entirely on traditional fiat currencies. While these central banks primarily purchase gold, the underlying reasoning often benefits silver as well. Precious metals function as a hedge against currency instability and geopolitical uncertainty. As global tensions persist, demand for hard assets tends to remain strong. The structural supply deficit that helped drive silver's rally has also not disappeared simply because the price corrected. Mining operations cannot suddenly increase production overnight. Developing new mines requires years of exploration, environmental approvals, infrastructure development, and capital investment. Even when prices rise significantly, it takes time for supply to respond. In addition, most silver production still comes as a byproduct of mining other metals. That means silver output depends partly on the economics of copper, lead, and zinc mining operations. Unless those industries expand production significantly, silver supply will remain constrained. Meanwhile, demand from industrial sectors continues to expand steadily. The global transition toward renewable energy technologies is creating sustained demand for silver in solar power installations. Each photovoltaic panel requires silver to conduct electricity efficiently. As countries continue investing in renewable infrastructure, the need for silver remains structurally embedded in that transition. Electric vehicles also rely on silver for electrical connections, battery management systems, and other critical components. The ongoing expansion of digital technology further increases silver consumption through semiconductors, circuit boards, and advanced electronics. These industrial applications illustrate why silver occupies a unique position among commodities. It is both a precious metal used for investment and a critical industrial material required for modern technology. That dual role means its price is influenced by two different categories of demand simultaneously. When economic uncertainty rises, investors seek silver as a store of value. When technological development expands, industries require silver as a functional component. Few other metals experience such a combination of investment and industrial demand at the same time. Another key factor supporting silver's long-term outlook is the continuing gap between paper markets and physical supply. Futures contracts and financial derivatives determine the official spot price for silver, but the physical metal must still be produced, refined, and delivered in the real world. Over the past several years, dealers have frequently reported delays in obtaining large quantities of physical silver. Premiums for coins and bars often rise when demand increases, indicating that buyers are willing to pay more than the official paper price to secure actual metal. This divergence between paper pricing and physical availability suggests that the underlying supply situation remains tight. Geopolitical uncertainty also remains a significant element influencing precious metals markets. The tensions surrounding Greenland have not been resolved, and discussions regarding potential military actions involving Iran continue to create uncertainty within global markets. International trade relationships between the United States and Europe remain strained as tariff threats and economic disagreements persist. These geopolitical developments contribute to a climate of instability that often drives investors towards safe haven assets. When global stability appears uncertain, capital tends to flow toward assets that exist outside traditional financial systems. Precious metals historically benefit from this dynamic because they cannot be created by central banks and do not depend on the solvency of financial institutions. Silver and gold often experience sudden surges in demand when geopolitical events escalate unexpectedly. Even if these tensions temporarily fade from headlines, they remain underlying risks that can quickly re-emerge. It is also worth remembering that the forecast suggesting silver could reach $130 has not been withdrawn. Keith Neumeyer, who leads one of the world's largest primary silver mining companies, has argued that the metal remains undervalued relative to its supply and demand fundamentals. As the chief executive of a major producer, he has direct visibility into mining costs, industrial demand, and the challenges facing global silver supply. His earlier prediction that silver would eventually reach $100 proved correct. When someone with that level of industry insight suggests that the market could move higher, investors often pay close attention. All of these factors together paint a complex picture. Silver has clearly experienced a sharp correction from its peak above $121 to its current level, around $82. China's growth target adjustment has contributed to short-term pressure on commodity markets. Sentiment has shifted from the excitement that surrounded the rally toward a more cautious outlook, yet the fundamental drivers that propelled silver upward have not vanished. Economic uncertainty, geopolitical instability, expanding industrial demand, and constrained supply continue to influence the market. This leaves investors facing an important decision about how to interpret the current environment. Some will view the correction as a warning that the rally moved too far too quickly. Others will interpret it as an opportunity to accumulate silver at a price significantly below its recent highs. The reality is that both perspectives contain elements of truth. Markets rarely move in a straight line, and the path forward will depend on how these underlying forces evolve over time. At this stage, the most important question for investors is not simply what happened to silver, but what happens next. Markets always move forward, and the decisions made during periods of uncertainty often determine long-term outcomes. The drop from the historic peak above $121 to roughly $82 has clearly changed sentiment across the market. Excitement has cooled and caution has returned. That shift in psychology is normal after such a dramatic rally and correction. When an asset experiences a surge of nearly 200% within a year, expectations tend to become unrealistic. Many participants begin believing that prices will continue rising indefinitely without interruption. When reality introduces volatility, those expectations are quickly challenged. Understanding market psychology is essential because sentiment frequently drives short-term price movements. When silver surged toward triple digits and then pushed past $100, optimism reached extreme levels. Some investors began projecting prices of $200, $300, or even $500 per ounce in the near future. While silver could theoretically reach higher levels over long-time horizons, assuming immediate and uninterrupted gains can create unrealistic expectations. When the price eventually corrected from $121 down toward $82, many of those same investors felt blindsided. In truth, the market simply followed a normal cycle of expansion and consolidation. Time frame plays a crucial role in interpreting these movements. Traders operating on daily or weekly charts may view the current decline as a significant trend change requiring caution. Investors with a multi-year outlook might interpret the same price action very differently. For someone evaluating silver as a long-term hedge against economic instability, a 30% pullback after a historic rally may represent normal volatility rather than a fundamental breakdown. The identical price movement can appear either alarming or insignificant depending entirely on the time horizon used to evaluate it. Another critical area to analyze moving forward involves industrial demand for silver. Many people still think of silver primarily as a precious metal similar to gold, but the industrial component of silver demand is enormous. Silver is widely recognized as the most electrically conductive metal on the planet. Because of this property, it plays a central role in modern technology and energy systems. Solar energy installations rely heavily on silver within photovoltaic cells. Every large solar panel installation requires silver to efficiently transfer electrical energy generated by sunlight. As global investment in renewable energy infrastructure continues expanding, the demand for silver within this sector remains structurally strong. Electric vehicles also require silver for numerous electrical components. As transportation systems increasingly transition toward electrification, silver usage within automotive manufacturing has steadily increased. Telecommunications infrastructure, including modern high-speed network systems, also incorporates silver in critical electronic components. Semiconductor manufacturing depends on silver's conductivity as well. Medical technologies, specialized batteries, and numerous advanced electronics rely on the metal for functionality. As global economies continue digitizing and electrifying their infrastructure, demand for silver within these sectors continues expanding steadily. The supply side of the equation remains much more complicated. Unlike some other commodities, silver production cannot easily scale upward in response to rising prices. As mentioned earlier, most silver does not come from mines dedicated exclusively to silver extraction. Instead, it typically emerges as a secondary byproduct during the mining of other base metals. Copper, zinc, and lead mining operations generate significant quantities of silver as part of their extraction processes. Because of this structure, increasing silver supply requires increased production of those base metals as well. Mining companies cannot simply switch on new silver production overnight when prices rise. Developing new mining projects takes years of exploration, feasibility studies, permitting processes, infrastructure development, and capital investment. Environmental approvals and regulatory requirements often extend timelines even further. Meanwhile, many existing mines are dealing with declining ore grades, meaning more material must be processed to produce the same amount of silver. Energy costs, labor expenses, and compliance costs have also risen significantly over the past decade. These challenges restrict the ability of global supply to respond quickly when demand accelerates. When demand grows faster than supply, markets typically adjust through price movements. That dynamic was one of the primary reasons silver surged so dramatically from around $30 to over $120. The structural imbalance between expanding industrial demand and constrained supply created upward pressure that intensified once investment demand joined the trend. The fact that silver has now corrected does not automatically eliminate the underlying supply imbalance that helped produce the rally. Another factor worth monitoring closely involves the relationship between the paper silver market and the physical silver market. Futures contracts traded on exchanges establish the official spot price that most investors reference. However, the physical metal must still exist within refineries, vaults, and inventories. During periods of strong demand, the price paid for actual silver bars and coins can exceed the official spot price by significant margins. Dealers frequently report delays in obtaining large quantities of metal when demand surges. If the current paper price around $82 continues diverging from the cost of acquiring physical silver, that gap may indicate ongoing supply tightness beneath the surface. When buyers consistently pay premiums above the futures price to obtain real metal, it suggests that demand remains strong despite temporary corrections in the financial markets. Such divergences often resolve eventually, though the timing can vary widely depending on broader market conditions. Currency dynamics also play a crucial role in determining silver's future price movements. Silver is priced globally in United States dollars. When the dollar strengthens, silver often experiences downward pressure because it becomes more expensive for buyers using other currencies. Conversely, when the dollar weakens, silver typically receives upward support as it becomes more affordable internationally. The dollar itself is influenced by interest rate policies, global capital flows, and perceptions about long-term financial stability. Another key factor to watch moving forward is geopolitical risk. The global political environment remains uncertain, and tensions involving multiple regions continue to evolve. Developments surrounding Greenland have not been fully resolved. Discussions regarding potential military actions related to Iran continue to influence market sentiment. Trade disagreements between major economic powers remain active as tariff disputes and policy conflicts persist. These types of geopolitical uncertainties often generate sudden demand for safe haven assets, including precious metals. Investors also monitor mining companies closely because their performance can amplify movements in the underlying metal price. Silver mining companies tend to experience larger percentage gains when silver prices rise because their profit margins expand rapidly. However, the opposite effect occurs when prices fall. Declining metal prices compress margins and can push weaker mining operations into financial stress. Not all mining companies are equally positioned to handle volatility. Differences in management quality, production costs, jurisdictional stability, and balance sheet strength can significantly influence which companies survive challenging periods. Sentiment indicators are another important component of market analysis. When optimism reaches extreme levels, markets often become vulnerable to corrections. Conversely, when fear becomes widespread and investors begin abandoning positions, markets sometimes approach important turning points. The sharp decline from the peak near $121 has clearly reduced enthusiasm surrounding silver. Some investors who previously believed prices would rise indefinitely have now become cautious or even pessimistic. That shift in sentiment may eventually help establish a foundation for the next stage of the market cycle.